Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss valuations, rates, and earnings, as well as retail trading and the impact it's having to stocks. Phil, we have a lot to uncover this afternoon. Let's start with valuations. I feel like we've been having the valuation conversations a few hundred S&P 500 points ago.
Yeah, I guess at the moment, though, we're still pretty close to all-time highs, and people are talking about the level of retail trading this week. And it probably makes sense to talk about whether we're in a bubble. I mean, it's kind of a pretty topical subject right now. And if you look at we talk a lot about how discount factors and the interest rates matter to valuations. And so we put a chart in today that actually looks at that. And it shows that as interest rates go down, you can see the blue dots go up to a higher PE ratio. And so basically it shows that as the discount factor or the interest rate goes down, valuations are supportable at higher rates. Where we are right now is around about that orange dot, which is right in line with the trend line. The only real outliers are the purple dots, which were the tech bubble, which a lot of people are talking about in respect to the sort of market highs we've seen right now. And we'll talk more about whether this is a bubbly market or a frothy market for tech. But you can see that tech bubble was sort of overpriced on a PE basis based on the interest rates at the time. But right now, we're not in a regime like that. I think what else is worth highlighting, though, is rates are not going down anymore. We have definitely sort of reached the bottom in terms of the longer term trend, and the 10-year rates have actually started to retrace back up. So all things to start to factor in when we're thinking about valuations for this year.
Let's turn to our next set of charts and take a look at COVID-19 data and where the stimulus money is going.
Yeah, I mean, that's one of the arguments for why the market's been so strong. I mean, the fiscal response, the monetary response, record low interest rates. And as this chart here shows, record amounts of fiscal stimulus as well, not just in America, but around the world. The checks that have been getting sent to people's letterboxes, the amount of unemployment benefits, the amount of money being put into the system is basically off the old charts. So we have a stimulus in the system that's helped us bounce back from coronavirus, deal with the shutdowns. And you can see in some of the other that actually, because of the stimulus and because of the fact that people have not had that much to spend their money on because they're working from home and not traveling anymore, there's been a huge increase in savings. Over $1 trillion in America has been added to people's bank accounts. So we do have a huge pent-up savings balance that's been built because of these factors.
Which brings us to retail trading. I think this is one of the most interesting conversations that we've had in the marketplace for quite some time. This is truly fascinating to me.
Yeah, I mean, we've had a couple of different factors that have helped boost retail trading. And I think the first thing was late in 2019 going to free commissions for a lot of retail accounts. And you can see in the data that started to cause an uptick in the amount of trading that was happening per account. But really the spike in retail trading has happened since we've had those stimulus checks and we've all started working from home. And if you look at some of the data, it's not real clear to define what's retail and what's not, but it's been reported that retail trading in the stock market has increased from 15 to 20% of all trades in the market. In the options market, a very similar percentage increase. So it looks like smaller retail trades are actually helping grow liquidity in the stock market and the options market pretty significantly in 2020.
And finally, this relates to the bubble and valuation we were talking about before. Again, I feel like this is another question that we've been talking about for quite some time, and valuations just tick higher.
Yes, but I mean, arguably you could say this time's different. There's some data that suggests that a lot of the stocks of retail and you can kind of tell what retail own, are actually outperforming. So it looks like so far the retail money, if they've been putting it into the stock market, on the whole, retail investors are buy and hold. They don't turn over that fast, and they may well be sitting on pretty good gains, which is a good thing, especially if we start to see the market soften a bit. At least it's not going to cause losses that need to be liquidated for. But also, and there's a really interesting study or survey that the Deutsche Bank guys did, looking at surveying their customers, where are bubbles in the market. And one of the strongest, indicators of bubbles that came out was Bitcoin. And we talked earlier today, we talked about the US tech sector in the equities market potentially being a bit frothy, but it's not anywhere near 10. Most of the other segments of the asset sort of allocation universe they talked about are pretty much average. So in terms of bubbles, the survey came back with not that much support for widespread equity market bubbles, but it did point to US tech. We know the Nasdaq's outperformed a lot. What's different this time is the amount of revenues and profitability in a lot of those tech companies, though. So if we try to draw a parallel with the tech bubble of 1999, the market had actually accelerated much more strongly in 1999, and a lot of the companies in 1999 were still running at losses, needed new cash, came back to the market and found that the market wasn't willing to like keep subsidizing those business models. This time, actually, a lot of the tech companies that have appreciated have pretty strong revenue growth and good profitability. So it's quite a different tech rally this time than last time.
Phil, actually, I want to throw more question at you. This is more from a philosophical perspective when we talk about retail trading. What's different that Main Street traders are doing versus what Wall Street traders have been doing for years? I mean, they go on CNBC, Bloomberg, talk their book, put out research reports. There's a number of blogs and so forth out there, short sellers and so forth. What's different than what Main Street is doing by using social media or different threads to talk their book? Or is it perceived that Wall Street positions are based on fundamentals? What's different philosophically?
I mean, I think it's important that retail investors do enough work to understand, to your point, whether fundamentals are driving the stock, whether the stock valuation is supportable, because we don't want all these new retail participants in the market to have a bad experience. We actually need the retail investors that aren't in the stock market yet need to get into stocks for their own financial stability in the future. So I hope they're all doing enough research to really understand that what they're buying has good valuation prospects, good dividend paying prospects, good growth prospects. That's what you pay a fund manager to do. So I hope that they're actually spending the time to look at the underlying businesses and working out what they're worth.
Yeah, that's an excellent point, Phil. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.